I'm Charlotte McLeod with investingnews.com, and here today with me is Tavi Costa, CEO of Azuria Capital. Thank you so much for being here. Great to have you.
Thanks for having me. Looking forward to this.
Me as well. And I think the first thing on the list, people may notice that we introduced you with a different company. So maybe you want to share a little bit about your new venture and the goals there.
Yeah, that was a company that we're going to be investing in a few different parts of the market. Mining is going to be a specific area that I want to be invested in. These strategies are going to be sort of aiming to deploy capital for the next 5 to 10 years. These are macro themes that I believe will unfold in markets for the long term. And I really want to make sure we deploy the capital the best way we can in those areas. So one is going to be mining, one is going to be energy, and another area is going to be emerging markets, mostly Latin America. So initially it's going to be funded internally, and then at some point we're going to take external capital as well. So that's basically what we're going after. It's going to be a fun time.
Yeah. Very exciting. I think a good time to be starting something new. And we'll try to get into all the three topics that you mentioned there. I thought we could start with your PDAC presentation from yesterday, since that's where we are right now. We're at PDAC. I didn't get a chance to see it, but the title is An Inflection Point for Commodities. Can you describe that inflection point you're seeing?
Yeah, I mean, this was a tough one because we have to come up with the title 4 months before the presentation.
That's hard.
I'm glad it's still relevant because it is relevant. I mean, I think we've seen gold prices go up a lot. Commodity prices overall have actually not kept up with gold prices, and I do think we're going to see a major catch up. And so we are at an inflection point for a lot of other commodities outside of metals even. I think energy is starting to have a move, but when you start seeing energy commodities begin to move, you start to see also agricultural commodities do the same. And so there's going to be a lot of opportunities in different parts of the resource market. But I'm also very excited about things like copper. I think copper is on the verge of a major move as well. We've seen gold, we've seen silver sort of establishing themselves in prices that I think are historically elevated, obviously, and mining companies are still yet to catch up to those levels when it comes to their margins are just exceptional in these prices. And so we haven't seen yet the equity value be re-rated at these price that we're seeing for metals. And so that's going to be a big change. And so I'm really excited about all those parts. But the inflection point in commodities overall, as we see gold prices staying here, is going to be a big investment thesis in my view.
Well, and I think what might make sense to talk about in that case, so where do you see gold in the cycle right now? We'll have all these other points following on from gold, but where do you see it at the moment?
Well, I think there's a sense that gold has gone up a lot and won't go up anymore, and I don't believe in that at all. I think the structural demand is coming from central banks. They still own about 20 to 25% of their balance sheets in gold. Historically, you tend to see it up to 70+% when they reach to a peak. So there's a lot of room. You can also look at the gold market relative to overall market cap of equity markets. I think we're somewhere close to, multiples away from prior peaks. The mining industry today is about 1% of overall global equity markets. Back in other eras when the mining industry was as relevant as is becoming now, was somewhere close to 11%. So a 1% to 11% is multiples from here. So there's a lot of movement still ahead of us, in my view. I think there's a lot of skepticism over the sustainability of these moves, and I am not skeptical at all. I think institutions are catching up with the idea of owning metals, owning resource companies, and it's a very complex industry, so it drove the market quite a lot recently because it's a small market, but there's lags. I mean, I think this is a very capital-intensive industry, and it's going to be attracting a lot of capital. This is going to grow tremendously, in my view. So, this is the time to be, in my opinion, just heads down, trying to find your best projects and your best ways of expressing these opinions in the markets, because it's going to be a long-term trend, in my opinion.
I think that's definitely a theme I've been hearing specifically here at PDAC is the larger institutions from outside the sector are now just starting to be ready to come in. So when you look at gold and silver in terms of the prices, do you have price levels in mind or just upward?
No, I don't. I don't usually. For me, my own principles of investing, I don't think of from a price target standpoint. I guess I'm not smart enough to figure it out where the prices go, but I think from a sort of think about having a checklist of things that you tend to reach at the peak of the cycle. So I'll give a few examples. When production begins to inflect higher in a significant way, supply will increase. Obviously, it's going to have an impact on prices. One, we're not seeing that. We're seeing contraction of supply in most cases. When prices go up a lot in metals, there is also a rush towards discoveries, and then you tend to see sort of a period of discoveries. We're not seeing that. I mean, especially in gold and copper and silver, those three metals, we haven't seen any discoveries whatsoever. So that's another aspect. CapEx. A lot of people tend to look at CapEx nominally, but you got to look at CapEx relative to GDP, size of the economy, or inflation adjusted. You can also look at relative to gold prices. And that number is still, really low, very depressed. We haven't seen that yet. M&A, we're seeing some M&A happen between the senior companies, but we're not seeing that go down to the path of senior companies is starting to buy a bunch of juniors. That's yet to happen. So sort of wake me up when all these things are there, and then I'll certainly change my view. And you can also look at metal prices relative to money supply, and other factors that you can look at in terms of, I'll give another one, gold reserves in the U.S. relative to federal debt outstanding. So today we're about 3%. So if you think about it, the U.S. debt is backed by 3% of gold reserves. Back in the 1940s, it was over 50%. So can we go back to that? I mean, these are big numbers. And so as we see that unfolding, I think the price is yet to reflect these changes. So
I think it makes a lot of sense to look at it like that. And I want to go back to the point you made about the lack of discoveries in gold, silver, copper. You had a good chart about that when it comes to gold on X the other day. So why is that? Is that because we have found all the ones that are easy? Is it a lack of capital for juniors to explore some combination? What is going on?
I think it's the latter, because there's plenty gold to be found. Of course, it's becoming geologically challenging to find gold discoveries. I'm not saying it's easy by any means, but there are discoveries out there to be found. Surprisingly, I'll give you one stat. If you look, the S&P Global has a way of tracking exploration budgets for companies in Canada, which is majority of the sector, and you can see that it's at a 4-year low. So we're seeing metal prices, silver prices go above 100 for the first time in history, and then we have gold prices reaching 5,000, and still exploration budgets are falling. So, I think Newmont just fired most of their exploration geologists. I mean, that's I'm talking about their exploration growth aspect of arm of their business. And so we're not in a world where companies are desperate to find new discoveries yet, which is kind of shocking, actually, because of prices being so high. At what level of price do we have to see until people start really, dumping capital into this early stage of the industry? So I don't know the answer to that, but I'm paying attention to it. And the fact that we are not seeing any capital come in, that's a leading indicator for discoveries. So if there's no capital coming in, there's not going to be any discoveries. And so, you can kind of time it that in the next 3 to 5 years, there's not going to be much of a change. Maybe 7 years, not much of a change of supply. So we have a crunch in a lot of different metals for sure.
Right. Things do move so slowly, so you can project that out into the future. All right, so we're in this situation. We've got gold moving. The rest of the commodities are going to follow. And we'll talk a little bit more about that in just a moment. But I wanted to bring up the U.S. dollar in this context because we've talked in the past about how it's facing a major long-term decline versus other currencies.
Yeah. It's scary because, not scary, but it's just part of macro cyclicality and how there are some secular trends happening right now. Gold is one of them, but the second one that I think people need to pay attention to and open up your eyes for is the derivatives of the gold trade. And one of them is the depreciation of the US dollar, not just versus hard assets, but also versus other fiat currencies. A lot of people have dismissed that opportunity of, thinking that maybe the Canadian dollar or the Canadian peso is going to rally. And it's possible. I do believe it's possible. The Japanese yen could rally. And most of the sort of, normal people that follow markets outside of the macro people Don't believe that that's a reality, and it is a reality. I mean, we're seeing emerging market currencies do better than the dollar. I think that stability of the currency outside of the U.S. is going to be a very important theme for investing. In other words, the U.S. economy is in a situation where, in my view, has to do two things. I mean, it's got two major issues. One, a deficit problem on the fiscal side and a deficit problem on the trade balance side. To fix those two problems, I think you need to do two things. One, lower rates, no matter where inflation is, no matter where labor markets are, you got to lower rates substantially. And the second thing is going to be to weaken the dollar. So that's going to be the green light for investing in emerging markets in a big way. We're seeing that already happen in the last, call it 6 to 12 months. But I think that that's going to accelerate over time. This is a structural change in the market that people are not paying attention to. And I get excited about Latin America because I think on top of it all, you also have a political shift happening in that whole area. It's Argentina, it's Paraguay, it's Bolivia. It will likely be Brazil. It will likely be Colombia. We're seeing in Panama. It could be in Mexico one day. Look at what's going on in Mexico. There's going to be pressure for a new political leadership there at some point. And so I'm excited about that whole region because I think it's going to be a big investment opportunity.
Right, and we've talked about that opportunity in the past. Maybe you can remind us how somebody might go about getting exposure to emerging markets like Latin America.
Well, I would think always from a standpoint of reallocation of capital. First of all, when you think about the dollar weakening, I would say that will have an impact on U.S.-based assets, capital that will flow out of those assets and go into other countries. So there's going to be opportunities elsewhere, even in Europe, believe it or not. And then you can think of emerging markets as kind of your risky bucket of the rest of the world. 80% of emerging markets index is in Asia. And so there's going to be a rotation within emerging markets from Asia, likely, into places like Latin America, which are only 7% of the emerging markets index. So that's why I'm so focused on that. It's like looking at mining and saying it's only 1% of the overall market cap of the global equity markets. And so I think that's going to be an important trend. I would also mention another thing. Let's look at Brazil specifically. Brazil has about same GDP it was in 2013, okay? So over 10 years, same GDP it was back then. Actually, it was slightly higher. It begs the question, why is that? And the most normal answer people will give, I know people are thinking about that, would be it's the dollar. And it is the dollar. The dollar had an impact on that. The dollar went up too much relative to the real. But another thing is, it's the interest rate environment. The interest rate environment in the country is about 15%. That's your risk-free rate. So you as a company would be actually borrowing money at, 25, 30%. How do you grow a business with those rates of cost of capital? So once we see the U.S. economy having to lower rates substantially, it's going to open the door for Brazil and other economies to lower rates too. Once we see that, it's going to unleash those economies in a big way. I do think you want to be looking for interest rate sensitive assets. Real estate is one of them. There's others. In those areas that would be unlocked a lot of value that have not been unlocked for many, many decades. So, yeah.
Yeah, I said this earlier in a different conversation, but there's a lot of rotations going on right now. Mm-hmm. I want to go back to commodities. So we have gold and silver, they're moving, and we're looking at what's going to be coming next. And I'm hearing a lot about oil and gas, the energy sector, and you mentioned that is one of the places that you want to focus. So what are you seeing there? How are you approaching that right now, those markets in energy?
Well, energy is interesting from a lot of ways. I mean, it's very under-owned in regards to even in the U.S. based assets. If you look at the U.S. based assets, energy is one of the lowest ownerships across sectors. I would say you're also looking at the drilling activity in the U.S., which tends to lead production, is contracting by about 30% in the last 2 to 3 years, which will have an impact on production eventually. And you look at the futures market, which we can look at how much speculators are betting on things. And we had, not too long ago, one of the most shorted positions in history. And so there's not many themes where you have this sort of, again, a checklist of ideas that's sort of telling you, well, you should maybe pay attention to this. And so when I saw that, I started buying a bunch of derivatives, call options on energy companies. And then the last thing I would mention, I mean, there's a lot more to mention, but the other thing I would mention is if you look at a chart of gold miners, they've been going up. If you look at a chart of copper miners, they trend very similarly, but they lag a little bit gold. So when gold prices or gold miners went up, copper miners have started going up too now. And if you look at energy companies, they are sort of like lagging slightly behind. And we have seen a 2-year consolidation and now starting to move. I think it could be explosive. I think a lot of people are dismissing the opportunity. A lot of people think that, electrical vehicles and all those changes are already being priced in oil markets now. And I disagree. I think there's going to be lots of opportunities in the next few years here in this energy space. And so I've been very focused on that side of it. I think you can make money on the mid cap and the large cap. You can still play derivatives. I think there's opportunities in oil itself or gas, nat gas. Refineries look attractive. You can even play the game of buying a mix of ideas. You can buy energy in emerging markets, and you're playing both, like Petrobras, for instance, and other companies. And so, yeah, I think there's a lot of attractiveness in those thoughts.
Yeah, I think that gives people a lot of ideas on how to approach it. And just to be clear, so when we're talking about energy, are we looking specifically at oil and gas and related things? Okay, so not so much the uranium side of things.
I mean, I like uranium. I just think that in this case specific that I was making the case for was energy related to oil and gas. But uranium looks attractive too. I mean, it's been a good trade over the years, and it is also in a structural trend. So it's one of those, just like emerging markets, if you see a 10, 15, 20% pullback, it's one of the things you want to be deploying capital again. So, I mean, there's a few of these trends, and every time you have an opportunity, market will give you an opportunity. You come in, and, it's still attractive as well. So.
Yeah, it makes a lot of sense. And I'll just briefly mention copper and take a look at how you're approaching copper right now. I've tended to hear about it as a longer term story, but it feels like the narrative is being brought forward for various reasons. So what would be the time frame you're looking at for copper?
I think in the 1 to 2 year horizon, copper is sort of where silver was not too long ago, and you saw this explosive move here. That could happen here. Certainly, and the reason for it is because we hit a phase that is called the discovery phase. When you get a discovery phase in price, none of us know where it goes, and it could be, it could be a double, it could be more. I don't know, but and it could be a little less too. But I think it could look very explosive. That's why I'm very opportunistic about that. And I would mention another commodity because. If you look at a course of like all commodities in the last year or 2 years of performance, you're going to find the laggers. The laggers are not a problem. They're usually an opportunity. So you want to pay attention to that bottom. And that bottom, you're going to find agricultural commodities. And when energy turns, which is turning, agricultural commodities turn too. So I'm paying attention to a few thins there. Yeah.
So we're talking like potash, phosphate, that kind of thing, or something else?
Or corn.
Okay.
Things like that too. So, I mean, there's plenty ways to play it. And for those that understand those markets, I think there's going to be opportunities there. I mean, think about it. You got natural gas prices going up, and then you have fertilizers, ammonia prices go up, and then eventually drives the situation with agricultural. So that's why they're all linked to each other. And when you see something lagging substantially, and you are potentially in a long-term cycle for commodities, you want to pay very close attention to the laggers. They're usually your best bet for the next 1 to 2 years.
Yeah, I think great takeaway. And I just want to go back to silver. You mentioned maybe copper could be looking like the next silver.
Yeah.
Everybody wants to know what that could be. You had another good chart that is essentially comparing silver miners to silver ratio, and it looks like it's at a low point. So what does that tell us about the price and the miners?
It tells us that the market thinks that silver prices at these levels is unsustainable. And I don't believe in that. And so if you want to invest in mining companies today, you have to answer that question. What's your view on that? My view is that we're no longer in an environment where silver prices will go low. like they were in the last 2 decades, meaning are we going to go back to a $25 an ounce environment? I think it's highly unlikely. Some people will tell you that silver has already crashed from 120 and it's on the way down. That's not my opinion. If that's your view, miners are pricing that. If your view is maybe we'll stay where it is, we're maybe even going back to 100. I mean, it's at a 85 and 90 and now went close to 100 again. I don't know. Your guess is as good as mine, and this is why I like the miners, because the miners at this environment, who cares where it is? Some of these companies have margins better than Google, right? I mean, a lot of these companies are mining at about $15, $17 an ounce. If you're selling the commodity at 80, 90, 100, I mean, what type of margin is that? So it just feels like that operational leverage in the market of mining is just not being priced, reflecting the price correctly. And I think it's going to be a lot of re-rating in that aspect. So,
yeah, I think that makes a lot of sense. And we're coming to the end. I'm going to give you, before I let you go, my fun question that I'm trying to ask everybody. So, if there was a young person, they're new to the resource sector, they have $10,000 they want to deploy, how would you tell them to do that?
$10,000, how they would do it? I think I would deploy in different, that's a good question. I think I would put some, maybe $3,000 or so into agricultural commodities, just because the timing of things. I would put another three to 4,000 into energy, and I would look for some maybe copper miners as the remainder. I think that sounds. Yeah, I mean, that would probably be at one place to be separating the capital. I mean, I'm just trying to think here out loud, but yeah, I like the asymmetry of agricultural. I like the trending of energy, and I like the long-term idea of mining. So I suspect that agriculture will be your most asymmetric bet in the next 2 years or so. But you said long-term, so I think mining looks very attractive for long-term and could be your biggest winner. So, yeah. Does that answer your question?
Yeah, I think I like to hear the thought process too. So thank you for handling that one.
I think there's a lot of, I invest a lot in exploration, and exploration is you make a bunch of investments on things, and you make several mistakes. But if you get one right, that's what pays off everything, all the mistakes you made. Yeah. Macro is very similar, and people get very political, and they eventually never looking for something that is exceptionally cheap. When I apply macro analysis into markets, there's a few things that look exceptionally cheap today that could be extremely asymmetric. Again, I could be wrong in 3 of them, and if I get one right, it's going to go on. One of them is agricultural, for sure. The second one, people are going to call me absolutely crazy, is TLT call options. In other words, treasuries, long-term treasuries, because nobody believes that the interest rates are going to fall substantially. So if you take the risk on the long end of the curve, which everybody's going to call me crazy, I get it, that is very cheap. Number 3 is Chinese equities. I know, Chinese equities is a second-order effect, third-order effect on the dollar weakening trade. Dollar weakens, Chinese equities could explode. Now, of course, you do this call options because you don't know. I don't know if they are going to invade Taiwan tomorrow, and you lose all your money. So if you do it through call options, you know what you lose. And there's a fourth one that it's going to surprise you. I also like call options on German banks. That's nothing to do with resources. These things, they're exceptionally cheap. These are very, very cheap 2-year options that if you get one of them right, it's just, that's how you make most of your capital. So I like doing these things every now and then, and I have this sort of kind of derivatives account that I play these bets, and it works really well because you always get one right. If you get one right, then it sort of makes up for your losses. And so because they're cheap, right? And it's not because you're playing a cheap market that nobody believes in it. I get it. Nobody believes in it. That's fine. But if one of them is right, it's an exceptional investment. So, yeah.
Yeah, that's really interesting. I guess if people are calling you crazy, maybe that's a good place to be.
Oh, I love being called crazy.
Yeah. Well, okay, I will let us wrap it up there. I'll
Yeah.
send you back out unless you had any very, very final thoughts.
I don't have any final thoughts aside from being very focused on these three big trends that I think are going to be remarkably important for investors, and also the fact that I keep thinking about a world. If you think about all these trade ideas that I mentioned, they kind of fall in the category of beneficiaries of two things: a weakening dollar and or falling interest rates in the U.S. And so that's where I come from in terms of my views.
I think that ties it together nicely. So thank you so much for taking the time. This was great.
Thanks.
Okay. And once again, I'm Charlotte McLeod with investingnews.com, and this is Tavi Costa.